We begin with Peter Lynch. Time magazine has called him America's #1 money manager. During the 13 years he headed the Fidelity Magellan Fund, it was a top-ranked general equity mutual fund. His new book, Beating the Street, offers advice on picking stocks and maximizing profits.
This is Peter Lynch. He is regarded by the investing community as one of the greatest investors of all time. And that's because during his 13 years managing the Fidelity Magellan Fund between 1977 and 1990, Peter Lynch was able to average an annual return of 29.2%. To put this in perspective, the S&P 500 over the same 13 years returned 477% or 14.4% annually with dividends reinvested. So if you had invested $1,000 in the S&P 500, by the end of this time period, you would have had $5,748. If instead of investing in the S&P 500, you had put that same $1,000 into the Fidelity Magellan Fund, you would have had over $27,000 by the end of that 13-year period. So in today's video, we are going to be going over 3 very simple principles that Peter Lynch employed while managing the Fidelity Magellan Fund to allow him to beat the market. So if you enjoy the video, make sure to drop a like down below and subscribe for more videos like this one.
I try to explain to people their great advantages, their edges they have, and that they should get involved in stocks.
Right.
And they should do it on the right basis.
This was on the first book.
Right.
Yeah.
And obviously I didn't make a great impression because the percent of people's assets involved in stocks has gone down. In 1960, people had 40% of their financial assets, including their house, in stocks and mutual funds. In 80, that was down to 25%. It's now down to 17%.
The first principle is just that simple. It is to buy stocks. Right now, only 62% of households actually hold some of their assets in the stock market. And this is because stocks over any significant time horizon outperform bonds, they outperform real estate, and they outperform gold. This is $100 invested in 1928 in stocks, bonds, real estate, and gold. This includes a 25% drop in the stock market in 1930 and a 44% drop in the stock market in 1931, as well as a 35% drop in the stock market in 1936. And we can see that despite these significant drawdowns over this 22-year period in the stock market, $100 invested would have been worth $355 at the end of this period. That would have outperformed treasury bonds, it would have outperformed real estate and gold. It would have been inline performance with corporate bonds. And when you continue this trend all the way till today, the numbers get absolutely insane because $100 invested in the S&P 500 in 1928 would now be worth almost $1 million. If you had put all of that money into small cap stocks, it would be worth almost $5 million. This is far outperformance compared to any sort of bond that you would have invested in, and even outperforming real estate and gold. So that is principle number 1. Simply buy stocks. Don't worry about these other asset classes. Over the long term, you will outperform them as long as you are invested in the stock market. But how do you know what stocks to buy into?
I'm saying people have natural advantages.
Yeah.
Let's say what you do for a living is you're involved in the restaurant industry.
Right.
You supply paper products. You supply kitchen equipment. You help build restaurants.
Right.
You saw McDonald's. You saw Chi-Chi's, you saw Chili's, you saw Cracker Barrel, you saw Dunkin' Donuts, Kentucky Fried Chicken, Taco Bell.
These are all success stories.
These were 40-fold. You made 40 or 50 times your money. You don't need to make that kind of money many times in your life, right?
Yeah, no.
That's all you had to do was follow the restaurant industry.
Yeah.
People are in industries. They're in the publishing industry, they're in the chemical industry, the paper. Why don't they just stay with that industry? You only need a few stocks a decade. How many good stocks do you need in a lifetime? Instead of people that are in the restaurant industry, they're buying biotechnology stocks.
Right.
The people in the chemical industry
nothing about
know nothing
biotech.
about it. The people in the chemical industry are buying oil stocks.
Right.
It's absolutely absurd. People don't understand their natural advantages, and they don't use them. So that's bad, number 1. But worse, number 2, is if you don't think you're a good ice skater, or if you're convinced you're not a good cellist, you're not going out and try it. But people are buying stocks anyway. Yeah. They're not discouraged. They just think it's a gamble. Yeah. So therefore, they go forward and they bet on one stock for a week and a half, and it goes up, and they make $2 on it. Then they sell it, and they buy something else. When 3 years is over, all they've done is generate a lot of commissions, and they've probably lost money. That's a mistake.
So your advice is what?
If you don't understand a company, If you can't explain it to a 10-year-old in 2 minutes or less,
Yes.
don't own it.
And that leads us to principle number 2, which is simply buy what you know. And at first, this principle can be a little bit confusing. However, a very simple thought exercise is to look at the things around you. What are you currently interacting with? For example, you might be watching this on an iPhone. If you had bought Apple stock 5 years ago, you would have achieved a return of 156%. This return would have far exceeded the S&P 500's return of only 93%. Maybe you are like me and you are watching this on a Dell computer. Dell over the course of the last 5 years has gone up by over 300%, far exceeding the return of the S&P 500. And obviously these are two massive examples. However, one that's more local to me personally is I am from the Midwest and we have a gas station known as Casey's General Store. They have expanded massively over the course of the last 5 years, and if I had paid closer attention to that and the moves that they had been making, I would have far outperformed the market over the course of the last 5 years, producing a return of around 195%. So what Peter Lynch is saying in this is pay attention to what businesses you interact with on a daily, weekly, or even monthly basis. Pay attention to what your friends and family are purchasing. What stores are they buying from? Where are they going out to eat? And look into those companies so that you can make sure you understand what they actually do as a business, how they make money, and how in the future they can make even more money than they are currently. And the third principle from Peter Lynch is to simply keep buying stocks and don't stop. And the example he gives around this in his book Beating the Street is if you had invested $1,000 in the S&P 500 in 1940 and waited 52 years, the value of that $1,000 would now be around $333,000. If instead of stopping there with just that $1,000 investment, you had invested an additional $1,000 at the start of each year, you would now have over $3.5 million by the end of this 52-year period. And if you went even one more step further and invested an additional $1,000 every time the market fell by 10% or more, which occurred 31 times over that 52-year period, you would have over $6.3 million at the end of that time frame. So there's a clear advantage not only to invest in the stock market, but keep investing in the stock market, especially when you see large drawdowns. So in recap, Peter Lynch has 3 very simple principles. Buy stocks, buy what you know, and do not stop buying. And if you use these 3 principles effectively, you can outperform the stock market. So with all of that said, if you enjoyed the video, make sure to drop a like down below. And if you like this type of content and you want to see deep dives into specific stocks, make sure to subscribe for more videos. Thank you guys so much for watching and have a wonderful rest of your day. And on this channel, we don't take ourselves too serious. This is the dad joke of the day. What's the difference between a piano and a fish? Make sure to check the comments down below for the answer, and thank you again for watching.